For today's SONAR update, we're going to talk a little bit about contract versus spot savings, as well as intermodal savings. We didn't get a lot of time on yesterday's show. It was packed to talk through some of the things we're seeing as far as intermodal savings and some of the really cool features of our intermodal dashboard. We are live today from the College Football Hall of Fame, but wanted to ensure we still had time to give our daily SONAR update. So we're seeing tender rejections stabilizing. There was quite a big fall from July 20th to August 5th, but now we're seeing that fall less quickly. Volumes are stabilizing as well and beginning to pick up a bit. Spot rates year to date have fallen since that earlier peak, but again are sort of stabilizing. But I think the interesting thing here is that contract rates are continuing to rise and that gap is narrowing. So you can see on our rates.usa chart, where you look at a baseline, there's been a larger gap between spot and contract, where spot has been significantly higher than contract. Then there was a bit of a dip as we saw rates fall, and now it's stabilizing again, where that gap is a little bit less. If you compare spot to intermodal rates, our NTI to VCRPM 1, those contract rates do not include fuel. You see about a 66-cent gap right there between the spot and the contract. However, those spot rates are all in, those contract rates are line haul. You can estimate that fuel right now, based on the DOE being about $5.45, if I recall, that most fuel surcharges are paying about 70 cents per mile. So again, we're really seeing that gap between spot and contract close, where those rates are very closely mirroring each other. That will be something that we're continuing to watch as both shippers, brokers, and carriers try to right size their spot to contract mix in this changing market, and how that will change throughout the rest of this year and peak. I do anticipate spot rates will go back up a bit, but it is nice to see those contract rates rising. I also want to talk a little bit about intermodal as a whole. If you look at overall in our intermodal dashboard, you can see the truckload to intermodal rate comparison on one side, and then the second side of this chart you can see intermodal volume trends. So you can see that intermodal rates have not risen nearly as much as contract or spot truckload rates, and intermodal volumes are continuing to rise and pick up. And so I wanted to dig into a little bit more on that savings index and show, compared to the prior few years, what a massive savings intermodal is offering in current market, as truck rates have gone up and intermodal rates have remained relatively steady with minimal increases. So you can see that huge gap with prior years compared to that blue line being current year in our own intermodal savings index, and how much higher it is than it has been. In our intermodal dashboard, you can look at mode optimization. So I picked some of the top lanes showing the most savings currently, and it really is in line with what we've been saying, with a lot of those East Coast lanes leading the way in the savings, specifically out of Atlanta and out of that Harrisburg, Pennsylvania market. We know PA has been hard to find truckload capacity. So digging into the details there, when you look at Atlanta outbound in our savings index, specifically on these lanes, you can see Atlanta to Chicago, Atlanta to Joliet, similar lanes, following a similar pattern to each other. And then you can also see Atlanta to Elizabeth, New Jersey is that orange lane. And you can see how the savings really have continued to go up as we tick towards the most recent dates. If you dig in and you go to just the last 3 months and look at that a little bit more closely, it doesn't look like quite as a significant jump, but really in all cases trending up. That intermodal savings is continuing to rise. When you look at the outbound Harrisburg lanes, those top saving lanes, which are Harrisburg to Atlanta, Harrisburg to Ontario, California, and Harrisburg to Los Angeles, so those two similar to each other. You can see the Harrisburg to Atlanta in blue, and then the two Harrisburg to California lanes in orange, and show those savings pretty significantly. When you look at the intermodal dashboard, you can actually click on those specific lanes, and all of the charts update to what this next graphic is, which shows the truckload versus intermodal rate trends on those specific lanes, as well as the intermodal volume trends. So looking at that Harrisburg lane, going specifically to Atlanta, you can really see the volatility in the truck spot rates. You can see the intermodal rates with a minimum rise, and then the van contract rates with a really pretty significant rise. So you can see up about 42% on average for the van truckload rates, up about 26% for the van contract rates, and up significantly less at 16% for the intermodal. So that is such a good reason to consider mode conversion, take advantage of those savings, and understand where that helps, even in a backhaul lane, like what would typically be PA to Chicago at a length of haul that's not transcon. And you can also see those intermodal volume mixes where they are picking up a bit of share in this lane. So good insights to continue watching what's happening in the truckload market and how that can push to further intermodal conversion and getting more volume off the roads and on the rails, and what that will eventually do to contract intermodal rates. We'll be watching those to see if an increase comes out. We had said previously that we thought we might expect up to 8% increase in intermodal contract rates. I would posit that in the wake of the current merger situation, that the two railroads involved in the merger aren't going to really want to make waves or give shippers or any of their customers any reason to oppose the merger. So they might sit quiet and hold on rate increases, which then means the other railroads will likely do the same so they don't lose market share. But we will be watching to see.